Right now, the biggest question in the market is simple. Where is smart money actually moving in 2026? And what should serious investors be paying attention to? And honestly, the answer is not hype-driven stocks. It's companies quietly building the infrastructure that will power the entire AI economy. So in today's breakdown, I'm going to walk you through my recent portfolio changes and explain exactly why I've started shifting capital the way I did. One of the first major changes I made was reducing my exposure in Brookfield Corporation after reevaluating its long-term upside potential. And instead, I started increasing my position in Brookfield Asset Management because the fundamentals simply look stronger from a long-term compounding perspective. When you look deeper, BAM offers significantly higher profit margins and a much more scalable asset-light business model. Now shifting to Amazon, this is not just an e-commerce company anymore. It's becoming one of the most important AI infrastructure players in the world. Most investors still underestimate AWS, but it quietly powers a massive portion of the global internet and enterprise systems. And now with AI integration accelerating, Amazon is positioning AWS as the backbone for machine learning and enterprise AI workloads. Even their new Graviton chips are designed to increase efficiency and reduce cost, which directly strengthens their competitive advantage long-term. But the real question every investor should ask is not what is performing today, it's what will continue compounding over the next 10 to 15 years. And that's exactly where my focus shifted, from short-term volatility to businesses with predictable, scalable cash flows. When I applied a deeper DCF analysis, BAM started to stand out as a significantly undervalued compounder. Because in the end, valuation only matters when you compare it against long-term earnings potential, not just short-term price movement. And BAM's structure allows it to scale capital efficiently without heavy operational drag, which is a huge advantage in today's market. Now coming back to Amazon, even at all-time highs, I'm still actively buying. And there's a clear reason behind that. Because Amazon is no longer just a retail story, it's a cloud computing and artificial intelligence infrastructure story. AWS alone continues to dominate enterprise cloud adoption, and that dominance is extremely difficult to replicate. And with AI workloads exploding globally, demand for scalable infrastructure is only accelerating from here. So when I combine AWS strength, AI positioning, and long-term cash flow potential, Amazon still looks like a core holding for me. But if you zoom out, this is no longer just about two companies. It's about the entire shift toward an AI-driven global economy. Every major industry, from finance to healthcare, is now being rebuilt using artificial intelligence as the core layer. And companies like Amazon are not just participating in this shift, they are actively enabling it at scale. But at the same time, no investment is risk-free. And that's where most retail investors fail to think clearly. Because when prices are going up, people assume it will continue forever, and that's where emotional investing destroys returns. That's why I rely on valuation models and long-term cash flow analysis instead of market sentiment. The DCF model gives stable projections, while hype is volatile. And when you apply that discipline consistently, your portfolio decisions become much more structured and less emotional. Even in high-growth stocks like Amazon, I'm not buying hype, I'm buying future cash flow visibility. And that's also why BAM fits into my portfolio, because it adds stability while still offering long-term compounding. So in simple terms, I'm not just chasing returns, I'm building a portfolio designed to survive and grow across market cycles. At this stage, investing becomes less about finding the perfect stock and more about building the right system that keeps working for decades. Because the real wealth is not created in short bursts, it is built slowly through patience, consistency, and strong conviction. And both Amazon and Brookfield Asset Management fit into that philosophy. Different industries, same long-term compounding behavior. Markets will always be volatile, but strong companies eventually reflect their true value over time. So my approach is simple: stay disciplined, ignore noise, and let compounding do the heavy lifting. In the end, the goal is not just to invest in companies, it's to invest in the future you believe in. If you found this video helpful or learned something new, make sure to like, share, and subscribe to the channel. It really helps support the content.